Hey guys, this is Nick from Financially Aware, and in this video I want to compare two oil ETFs, XLE and VDE. And both of these own real oil stocks. They're not just like USO that owns oil futures or something like that. So these are something you would buy if you think oil is going to appreciate soon, or you want the dividend because they both have really good dividends. So VDE is owned by Vanguard and has an expense ratio of 0.1%. XLE is owned by State Street Global Advisors and has an expense ratio of 0.13%. So the difference between these two is almost invisible. I mean, it's the difference between $10 and $13 per year on $10,000 investment. And XLE has been around longer, has more assets under management, but that doesn't really matter much. In terms of the holdings, though, this is where they differ. XLE has 28 stocks in its ETF, while VDE has 127 stocks. But the concentrations are very similar. So the top 10 stocks make up 78% versus 74%, and the top 15 stocks make up 82% versus almost 89%. So after the top 15 stocks, the rest is 18 and 11% or so. So if you look at these top 15 stocks, you'll see that the first two are Exxon and Chevron, which are about 45% of these ETFs. So just buying these ETFs, you're basically 50% of your money is really just buying Chevron and Exxon. And then the rest is 5% and less of pretty much the same stocks: Phillips, Conoco, Phillips, Kinder Morgan, EOG, Valero, Schlumberger, and whatever. So the real difference between the two is, since VDE has 127 stocks, a lot of them are these micro caps, and you see they have 5.5% of their ETF is micro caps, while XLE is only 0.31% micro caps. So the rest of their breakdown is kind of similar there. So that's the real difference. And let's see how that affects the performance of these two. So here's the performance of XLE and VDE, and on the side here is the percentages in performance. So you see that it's almost similar, but XLE is in green, VDE is in purple, and VDE is always lower in performance than XLE almost all the time here. And even in 2019, the difference got really big, almost to about 10% difference in performance. And I guess that's because the large caps in XLE outperformed a lot of these micro caps in VDE. So they haven't been doing so good, especially with the lower oil prices. So the large caps are faring better, and it shows in the performance here. So because XLE to me is the better ETF to buy, in my opinion, and when I'm looking to buy some oil stocks, finally I'm going to be looking probably towards XLE to just buy that, so I'm diversified in a lot of different oil stocks. And here on Simply Safe Dividends, which is a really good website, you can build a portfolio, and it gives you all this really great information. So I downloaded all the XLE stocks and pretended that I put my holdings in proportion to their percentage of the XLE of $10,000 worth. And so you'll see that the dividend yield is 5.4. Your annual income would be $542, and the dividend growth over the last 5 years is 2.1% per year. However, the dividend safety, you see, is not that great. Okay, 7% may be unsafe, 53% is borderline, 39% is likely safe, and 2% is unrated. So let's take a look here. And so I sorted by the largest percentage of the portfolio in XLE, and of course that's Chevron, Exxon, Phillips 66, ConocoPhillips, and whatnot, right? So here's the dividend safety, 65%. You know, the next one, Exxon Mobil, is 55%, which is kind of borderline. So a lot of people are rumbling that Exxon Mobil may have to cut their dividend, and if they do, the dividend of XLE will, you know, obviously go down. So that's something to think about. You know, Phillips 66 is still safe. ConocoPhillips is still safe. EOG is very safe. Valero is borderline. Schlumberger is unsafe at a 35. So just looking at these rankings here of their dividend safety, which is a very good ranking, if you see their history of how they rank these dividend stocks, they're almost always early in warning before the stocks cut their dividends. So their rankings are very good. And if you look at XLE, Occidental still is unsafe even after they already cut their dividend by like 86%. So they're saying that even their new lower dividend is still at risk of getting cut more. So you know, something to think about even with these ETFs. Even though you are diversified, you're still owning a bunch of oil stocks, which some of them are, you know, very unsafe in terms of their dividend being cut. Halliburton is almost certainly going to cut their dividend according to these rankings here. So you know, something to think about, but at least you're diversified with a lot of these oil stocks. So if you like the oil sector and you don't necessarily know which ones to buy, and you want to buy a bunch of them for the relatively good dividends that they're paying out right now, because this, you know, their prices have been hurt so much, it may be a good long-term bet to just buy one of these ETFs like XLE or VDE and just sit on it for a while and collect the dividend. And that's kind of what I'm looking to do. I just want some good long-term safe dividends, you know, and buying XLE, you know, some of these dividends are going to get cut, but over the long term, if oil recovers and their stock prices recover, the dividends will also recover eventually. So it all depends how long you're willing to wait and if you can buy them at a good price. So I'll be watching these things. I'm not buying anything yet, but I got my eye on them. And so this is how you can also look into any ETF or any individual stocks. And some other really useful features on Simply Safe Dividends is it shows you every month how much you'll get in dividends for the stocks that you put in here, and it even shows you the payment calendar of when the dividends get paid and how much they are. I mean, if you were to do this on your own and try to figure this out, it would take you hours upon hours to try to do that. So this is a big time saver here. It also shows you the diversification of your income. So here you see that your top sources of income, 30% is Exxon, 23% is Chevron, and all these other ones. So if you look at it here, it shows you how much income from each one and what percentage it is and their safety rating. So the top, you know, 10, 12 is like 80% of the income. So if you see that at the bottom here, some of these are $1, $2, $3 a year and they're unsafe. Who cares if if Noble Energy stops paying you your $1 a year dividend? You don't really care. You care about the bigger ones, and so you want to make sure that those are still safe. It also has the dividend growth. It shows you over from 2008 how the dividends grew on XLE ETF. And it also shows the dividend growth for each stock and the 5-year dividend growth, and if they're growing this year or not, and how it is compared to other years. So the information here is just amazing information that if you tried to gather this on your own would take you tens tens of hours and so much energy to try to find this stuff on your own. So I really like this website and the information it has on here. That's my look at the difference between XLE and VDE and why I think XLE is the better ETF. If you like this video, please give me a thumbs up and leave a comment if you're thinking of buying either of these ETFs, or if you would rather just buy some of the oil stocks individually and leave out the weaker ones with the riskier dividends. If you have not yet subscribed, please subscribe now. Thank you for watching.